Accounting systems. The topic I chose to speak on is a transaction. You may be asking what a transaction is. Well, it is any event that affects the financial position of the business and can be measured with faithful representation. Accounting is based on actual transactions. A transaction is an event that can be reliably measured in dollars and affects the financial position of the organization. Transactions are the basis for accounting. They increase or decrease assets, liabilities, or equity, and the accounting equation remains in balance after each transaction. Accountants use a three-step process to analyze transactions. The first step is to determine the account and the type. It's important to know what type of transaction this is. Is it a debit, a credit, a payment, a withdrawal, things like that. The second step is to determine if each account is increased or decreased. And the third step is to determine if the accounting balance remains the same. It is important that with the accounting equation that everything is in balance. If it's not, that means that there is definitely something wrong and you need to go back and check and see what the issue is. Why are transactions important to accounting? Transactions affect the accounting equation. They can affect assets, liabilities, and equity. The accounting equation is recorded on the balance sheet, which guides the financial decisions of the company. If transactions are not recorded properly, then companies are making financial decisions based off of inaccurate information. It is important to make sure all transactions are recorded on the general ledger, otherwise a company can be in serious financial trouble. A Bible verse that goes well with this is Luke 14:28-30. Suppose one of you wants to build a tower. Won't you first sit down and estimate the cost to see if you have enough money to complete it? For if you lay the foundation and are not able to finish it, everyone who sees it will ridicule you, saying this person began to build and wasn't able to finish. It's important to make sure that everything is in line with your transactions because that can affect future decisions of the company. Transactions themselves are not a concept, but they are an important part of the bigger financial picture. Transactions can show trends in spending and point out weak areas within the organization related to spending. Those trends can be easily spotted once the transactions roll up onto other financial documents, such as the balance sheet, which will cause an organization to make decisions on spending. Every check, payment, deposit, and withdrawal is a transaction. Making sure that these are entered correctly is extremely important. Transactions can help organizations spot trends or areas that need reduced, so it is important that a transaction is entered in accurately and promptly. If a company has to wait on information or does not know that the information is coming, that means decisions can either be delayed or made with inaccurate information. Transactions affect the accounting equation, which rolls up to the balance sheet as well as other financial documents. It is important to have controls that are set over transactions, as bad spending habits can have rippling effects on all of an organization's financials. At a mid-level standpoint, it is imperative that accuracy and control of transactions are of the utmost importance. Transactions allow executive level management to spot trends with spending. This snapshot of finances shows what an organization is spending its money on and seeing areas where spending can be improved. For example, if a company is spending $400 on office supplies a month, they could look into entering into a contract with an office supply company or seeing why so much money is being spent every month. These trends allow an organization to have an in-depth look at finances and help them make better decisions. Even though recording transactions is pretty black and white, they can still be fudged to cover up unethical purchases or just purchases that someone within the company should not be making. Organizations can also leave transactions off of the general ledger, which will make it look like they had higher profits. If this was something that I were to come across, I would immediately try to rectify the situation. I would go back and make whoever it was that tried to cover it up fix it, and then make sure that there was a fitting punishment. This could be writing them up, a verbal warning, or, depending on how severe the situation was, terminated.